Ladies and gentlemen, traders of all types, welcome back to another TradingView show. And we have TradeStation's David Russell as our guest, where, if you've been following this show now for several months, you are getting a breakdown on markets, both educational and spotting out some interesting moves that are happening on the charts. Now, it is important for me to say that this show is sponsored by TradeStation. TradeStation pursues a singular vision to offer the ultimate online trading platform and services for self-directed traders and investors across the equities, equity index options, futures, and futures options markets. Now, before I hand it over to David Russell, who is their global head of market strategy, let me also just say something that I always like saying on these shows is that David Russell also runs the TradeStation account on TradingView. So if you go to tradingview.com, look at the TradeStation account, you will see all of the ideas that he is writing, publishing, and charting about markets. And if you follow these ideas, I'm pretty sure you're going to learn something new about markets and really walk away with something, as well as following this show. So David, take it away here because I know there's a few things you have to say before we dive deep into the markets and what's been going on.
Sure, great. Well, it's great to be with you, Steph. Thank you very much. I wanted to just start off by just showing a few disclosures. And here we are in the second half. And it is an interesting change that seems to be underway. Last time we were on, we were talking about the situation in the Russell 2000. And at that moment, it was in a very tight sort of range, and a lot has happened since then. And one of the things we're going to get into quickly is some of the ways this rotation is happening. It's gotten quite a lot of attention when you look at different sort of commentators and things like that. I want to just show you these standardized returns of key ETFs because I may be discussing some of these.
On that note, what type of charts do you have for us to go through along this theme? And even when I was great. Okay, you were just showing me this.
Yes.
Love this ratio chart.
This is a chart of the Russell against the NASDAQ. And if we can see here, this is the thing I love about one of the many things I love about TradingView is you can easily make these ratios. And I just flipped it over to a 2-week candle of literally the Russell's price divided by the NASDAQ's price. And you can see here that we're back to levels from 2000. So you can make a lot of arguments here that, it's it reached an extreme, it's overvalued, that the NASDAQ's overvalued, the Russell's undervalued, all those things are in place. Now, simply because something has gone down a lot doesn't mean it's going to go back up. All those are points. But the thing is that what really caught my attention here, actually, it's interesting. I put it on the 2-week candles. Look at this bar here. Now, I have down here rate of change. The rate of change for this is 11 points. So it's like 12% gain. If I kind of look, I can see that is the biggest 2-week move since March of 2002. It looks like, yeah. So you can see down here, these guys are set up for rate of change with the 1-bar interval. So this is historic. This degree of kind of surging and move. So this is the first thing just to kind of start with to say that there is data here now to show that what we're seeing is not just a normal kind of bounce. It is more significant. So let's go back now to what we had done this TradingView idea a few weeks ago, and this is the chart remaining from it. I'm actually going to put back onto it Bollinger Bandwidth, because that was one of the key things here that was important. Bollinger Bandwidth had really narrowed down here to, at the time, it was the tightest level, I believe, since before COVID. It was an extremely tight squeeze. We had this strong triangle, and we were holding these levels. And so we had done this TradingView idea right around here, and then the CPI report came out, and it kind of surged. And we had talked about this before, but there's a lot of things about this that kind of seem to confirm that this is, more significant. If you look into the internals, we're seeing a lot of new highs in the Russell. But on top of that, I think the bigger thing is that when you take a step back, there is an argument, fundamentally for some of these things, especially if we do see interest rates moving lower. We're at a spot now where if you look at some of the earnings that have come out from some banks recently, they have been pretty good. They've seen real improvement in the underlying fundamental businesses of these banks. And I think that that's an important sort of thing, the regional banks and things like that. is that when banks do well, they make a lot of money. And people have kind of forgotten that the banks even exist as an industry. But banks can benefit from interest rates easing. They're going to generate more loans, which generates revenue. They're also going to do better on their underlying lending margins, and they're going to have fewer credit losses as rates go down, and the economy kind of gets a cyclical recovery. So it's setting up for a situation where, if you're thinking over the longer run, the banks become, there's a big argument for them. And I know we're not always looking at long run investing here, but the problem is, or the thing is if we're now in a period of a significant investor rotation away from mega cap growth, where it has been in many ways since like 2015 or 16, if it actually has some of that money move over into these banks and the things like that, that is something that will be meaningful for the small caps, and it looks like it's happening now. So we see it in the fundamentals of the banks, and we see it in some of the things of like the surge that we're seeing here in the price of the small caps. And so to me, this is kind of telling us that this rotation is underway.
Now, I have to say, for those who have been following this show, you know that David and I have covered the Russell Index for quite some time. So we've been following and tracking this move. And the first chart that you showed, which was the ratio of, I think, the NASDAQ 100 to the Russell, there it is. Yes, yes. So this chart ratio, I have to say, is fascinating from two really interesting things that caught my eyes and that you mentioned. Number one is, just technically speaking, it's so interesting to see that sort of same level from the dot-com bubble coming right back into play, and potentially the bottom happening at that point, or at least we're getting some sort of price action just to show that bottom matters. And then also the other thing I'd say too is I just didn't realize, I mean, I knew that the NASDAQ 100 was performing really well, all the large cap tech stocks, but I didn't realize its performance relative to the 2,000 small cap companies with a market cap under 2 billion, where it was that poor, like dot-com bubble level poor. So, I mean, yeah, what a way to kick off the second half of the year. To me, if I could print this chart and hang it and remind myself to look at this on December 31st, I might do that right after this stream. It's like, check on this chart on December 31st to see what changes in market. So yeah, I just want to point that out, that this chart really brings up a lot of interesting insights about the markets at play, especially the 2,000 plus companies in the small cap index that, might have been overlooked for quite some time, possibly.
And another catalyst for that is, I mean, we're not going to get into any kind of politics too much. The thing is that if Trump gets elected, there's an expectation that we will have an easier environment for M&A. And that is also something that is, potentially beneficial to small caps. We have not seen an M&A cycle in a while. And if we get one, that has an impact on small caps. So I think, when you put all the things together, it's like you can make a bullish cases for AI, but you get to a point when it's relative value, and it's like a lot of the good news has been weighted in now for AI, and a lot of good news has been neglected for small caps. And when investors, if you look for any kind of just return to normalcy or the way things long term are, and it can give you a move for a period of weeks and months. And I think that's the way to think about it, is this idea that, necessarily, the NASDAQ is done forever, or anything like that, I think is not, the sort of thing I'm saying. I'm just saying that, moves like this can last for a period of weeks and months when it's an investor rotation like this. And then it might just sit. The Russell might rally back to its high, from 2021. And then it could just languish there for, months. But the thing is that it's not there yet. And in many ways, that's a spot where people might kind of be looking. So if you don't mind, I want to very quickly here in the S&P, because there were some patterns with that.
David, yeah. I have to say, and let's put the S&P right on the back burner, but you said an aspect about M&A, which reminded me, something that you should pull up on the chart is one of the large private equity firms like Apollo, APO, or KKR. And I was right when you said that, I thought of these charts. and I realize, are they potentially also showing us that there's that, is the market getting ahead of this sort of potential environment where, right, it's more business friendly to M&A or private equity moves, and seeing KKR and APO at all-time highs. I just saw that yesterday. The charts just looked like they were straight up and to the right. And then you saying that had me thinking like, oh wow, this move might be in play as we speak.
Well, you make an interesting point. In some ways, I have not studied these companies that closely, but it makes me think of something else, which is one of the senior gentlemen at Goldman Sachs earlier this year. I can't remember if it was their chief operating officer or the chief executive, but he basically said we're going to see more IPOs going forward. Now, these companies IPO a lot of their portfolio companies, and that's how they often make their money. So the thing is that I would also mention that if we get more IPOs, that in some ways is a net negative for the mega caps, because people are going to sell some of the Nvidia to buy the new companies coming into the market. But in some ways, it's all the same thing. It's a question of money shifting from this, group of 7, 8 companies that are the massive mega caps into everything else. And there's a lot of things that now suggest that's going to happen. So, or that there's pieces of it are starting to come together. And the thing with these small companies is also consistent with that stuff.
Very interesting comment. I think it was from Goldman Sachs that you were saying about the IPOs.
Yeah.
And yes, precisely. For those who don't know, private equity firms oftentimes are sort of conglomerates for many large businesses, right? They buy tons of businesses and hold on to them and run them. And then maybe at some point they IPO them to sort of cash out. So this is an interesting one. Now, going back to the S&P 500, because I definitely want to see your charts on that. Just
It's a few things. One thing that's interesting to me was this price streak. This was the longest winning streak, the 7-day winning streak here, since back here. And I'm not really sure exactly what to make of it, to be totally honest. But if you look on like the hourly chart, this run of hourly winning candles was the longest. It was 16 winning positive hours. It's the longest I could find going back to the beginning of the century. So I'm not sure if I'm exactly right about that, because I mean you have to look over so many bars. But to me, I think it's interesting to kind of just to see that this was a little bit of a move that seems to have caused a little bit of exhaustion, but it also happened at the end of the quarter. So a lot of these are sort of things where all these things are, kind of honing in on the same point, which is quarterly rotation, investor rotation. We hit a high at the very end of, I'm sorry, it's not the end of the quarter. I was looking at the wrong thing here. It was the middle of July. But the key thing is that you kind of come into this period when it's a light, sort of amount of volume. Things just drift higher with that last kind of zombie drift. And then people come back from the holidays and they get back to business, and things get kind of more volatile and things start to happen. And I think that's what we're seeing now, is that as things kind of come back, we are seeing real business of people doing real changes. And that's where we're actually kind of seeing here. So I just want to mention this because honestly, I'm not sure what to make of it, but I wanted to point out that this kind of streak like this is, when it comes off low, it might be bullish, but sometimes you see things like this near the end of a move when there's that final just drift higher, and then suddenly the selling starts, and then it can last for a while, or at least the volatility. But what I think is interesting here is that we got to a spot where we saw sentiment actually get pretty bullish if you look at the different surveys. Once the market kind of hit that peak as well. But now as we look, I want to go here and look on this chart at the at some of the different levels that were popping up. Now, I have this thing set up. I should actually make this red because this is a bearish Fibonacci retracement. But there were a few things here that matter to me. First of all, we had essentially the close of this week right here. And things started getting a little bit, to me, I had a line right here. And I said, all right, we're getting under the close of the previous week. And we stayed under it. That was the first signal. Then what's interesting is if you look at this drop that occurred between the 16th and the 22nd, well, yesterday we went right up and stalled the 50% retracement of that, which was also not a terrific sign. So the thing is that now we're in a period where, this is a pretty strong kind of of sign that the short-term trend, is essentially bearish. But that doesn't, really mean that we're going to get, maybe significant breakdown through here, because I do think it's important to realize that we're, kind of right around this whole period here through June. And if we actually look on one of these charts, where did I put it? Well, anyway, the problem is sometimes I have too many charts and I'm not sure where to put things. But if you look at this
I
outside
think a
day
lot
right
of
here,
traders can relate to that.
I don't want to waste time trying to find it, but basically this candle, June 28th, this whole range through here, I think is now something we need to be watching to see what happens. We had talked about how the market was forming these tight ranges and it would rally, move sideways, and push higher. But then after it pushes higher, it gets to the spot when it pulls back more deeply. So I think now we're in a spot where we kind of have this level. Now, I have had a suspicion that we would see a period of time like May of last year. And that was a time when, we had kind of dodged a bullet on the banking crisis, on the regional banks blowing up, and the market, and then we were waiting for the Congress to raise the debt ceiling. If you look back to this period of time right here, in April and May of 2023, the market just ground sideways. It was a wait and see period. And I think right now we're in that sort of spot as well, where, the Fed is expected to cut interest rates, but when? 2 months from now. So we're going to get at least one more CPI report before then we're going to get the July report in August. We have the Fed meeting at the end of this month. So we have a lot of things out there. We have a lot of earnings coming, and now's a time where we could simply enter a sideways period. And I think that's important now to kind of recognize that there's nothing really that says if we're going to rally, we're going to rally now. And there's a lot of things that people see that they're positive about. And, we have, what is in many ways the longer term trend, the intermediate term trend still are pushing to the upside. So now we have a spot of some potential support here. And we're at a spot where we've pulled back pretty decently. And now it might be simply a process of paying our dues and chopping and waiting to kind of see what happens. And I also think it's important to remember or just notice that if we look here on the weekly, we had a bearish outside week and we've broken down through some various lows here. So I think at this point, we're trying to kind of hold these lows, which correspond to that price range we showed from late June. And I think now's going to be the time to see if we hold these lows or if we or if things get worse and break lower. I think that's where we are right now. We have GDP tomorrow morning, which could be very important for this. And then after that, we're going to have a lot more earnings. In fact, I'll just show you very quickly over on TradeStation. I have this set up, the earnings dates. These are just some of the earnings we have coming up. I have this set up in a way that you can see, stocks that trade a lot of options. I like listing them out like this by time. And this is one of the other little functions I wanted to show people.
Fantastic. And how about the fact that as we record this, I'm looking at the tabs at the top of your screen. I'm noticing that the NASDAQ 100 is down almost 3% today. The S&P 500 is down almost 2%, and the Russell's almost flat, which is such an interesting event to be happening right as we're speaking about these themes, which is the potential sort of, broadening participation of more stocks throughout the Russell 2000, and then the weakness that you just spotted in the S&P 500. Just curious, what are your thoughts even on today's price action in the context of everything we're saying?
Well, I think the Russell, the S&P and the NASDAQ have become increasingly the same index, if you look at the way they behave, simply because of the fact these companies have gotten so big. And so, yeah, I agree. This is exactly what we're talking about. If you look at this chart of the Russell, essentially you can see that, it has everything intact where, just think about it. Again, the charts tell you things. This is the high for May. It's above the high for May. Then you look at the NASDAQ. Well, it's also still above its high from May, but it's above, if you look where it was, say, a few weeks ago, it is definitely, below those highs. So you see here that all of this is showing us that there's been a very clear sort of short-term change. But I agree when I look at something here like the Russell. To me, what's interesting is that it's first of all, forming an inside day here, and that is a potential bullish continuation pattern. And I think also there was a Fibonacci level here that if you actually look, again, I don't have it on this chart, but this was essentially the kind of range beforehand. You're trying to somewhere I had, depending on where you I think it was from here. I don't have it on this chart, but basically you can see that regardless of where it was, we basically held a 50% retracement of this move. Now we're not at a 50% retracement of the move above that high. I'm not sure that's the level that you'd really want to look at. But what's interesting is that we rallied and we did not have any kind of significant pullback. And the other thing is that when you come off of something like this, when you have that incredibly tight volatility and that tight range, once it starts to move, the pullbacks historically in anything are very tight. So if you look at various banks, I think if you look at some of these banks I've been looking at, like State Street or something, I mean, look at how it's basically had, this is right here, the pattern. I mean, this is interesting up here, but look at this pattern. Rallies back to the highs and just rips through it. This is what happens when you get the tight pullbacks. That's just like we were saying about the S&P when it started back in November. You get the rally and tight, see this incredibly tight action? And that's what we talked about, these tight ranges, the tight ranges that come early in a move. And then later in the move, see, we rally and you get here a tight range continuation, tight range continuation. Then as the rally matures, you get deeper pullbacks. So now when you look at this, this is essentially, if you go back to the State Street chart, or if you look at some of the banks, this is what we see here. Rally, tight continuation, and then move to the upside, or a tight consolidation and move to the upside. So all this is consistent with money that's just kind of surging in, and it is consistent with that sort of investor rotation. It's the beginning of a potentially a more sustained move.
I have to add to that as well the aspect of, even as you know, we tie this back to today's price action, which is significant. So I think worth tying back to today's price action. We were just looking at State Street. You know, State Street is green right now, and that's just such a, you know, it's not like it's up 10% or something, but it's almost up 1%, while the S&P 500, as we mentioned, is almost down 2%, NASDAQ 100 almost down 3%. So it's very interesting just to see how all of this is unfolding literally as we're recording this show and doing it live. So this next chart you have up for us, this is the NASDAQ Bank Index, correct?
Yep.
Wow, so it's green today too as well.
Yeah, this is a weekly chart of this. And we had done this in one of our TradingView ideas recently when we compared, I believe, if you look back a couple, Steph, if you want to look back at the one we did, we basically said, I think that chips versus the banks, this one here. But, you know, we had kind of broken down some of the things that you saw in semiconductors. You can check that out. We did it back on the 22nd. But this is the chart from that. But I think it's interesting just to, again, realize when you look at the bank ETF here, or then this is not the ETF, this is the index, but this includes things like State Street. That's why I was looking at State Street, because at the time I was looking at the members of this index. But you can see here how this basically had this tight consolidation. And what's also interesting is we've talked about this pattern before. You close at a weekly high, and then you get continuation. So basically that close right back there on that week that began July 8th was the highest weekly close since really before the crash of Silicon Valley Bank. And now you can see once it closed above that, it just punched higher and it continued. This is exactly the sort of thing that that we've talked about many times. And I think that now as you kind of look at this, if you kind of roll back the clock, and I think sometimes people should think this way, because even if we are not like, long-term investors like pension funds, those are ultimately the people who in many ways move the market. And those are the trends that traders want to be seeing and kind of knowing what's happening. And if you are, a long-term sort of investor and you're thinking about allocating money and buying something now and holding it for the next 2 to 3 years, and you say, well, the Fed, let's just assume that the market's right and the Fed is going to cut a few times in that time. Well, right now, if you're thinking, what is something that has a probability of doing pretty well, they might look at something like this. That will realize as interest rates come down, these companies' profitability will improve and all these other things. And we're starting to already see it this earnings season. This is kind of what I think is is what's happening. And I just want to point this out because this is to me a pretty significant sort of pattern now that we're getting the close above that level. And it's interesting just to kind of see where it stands versus March of 2023. It basically says that this experience, this nightmare, is now done. And we have to just kind of cross that off and now say, where's the future? And I think that's like, it's like when Tesla, like back in 2019, had these manufacturing problems, but when those were solved, it was like, it was just erased. There was this huge chunk of time that people weren't sure. And then it's just, you just cross it off and say, we've now entered a new period where we know that they have the manufacturing and the margins under, improving. That's the future. And that's what the market does. It will simply say, all right, now we have a pretty good sense of what the future looks like. And that is the world we're in now. And in this case, it seems like that's what's happening with the banks.
So I have to say on that note, for this chart, which I did not know, so this is something I was not aware of. I had no idea that the NASDAQ Bank Index, this chart you have up in front of us now, was effectively trading below the Silicon Valley bank crash, which for many of us was the largest, that was the largest bank crash for many of us since the financial crisis. I think you could argue. I had no idea that the bank index only just broke out above that again. I didn't realize that all this time banks were effectively, as an index, was below that level. So like, what a significant moment. And if, to your comments about the Fed, if the Fed is thinking about now cutting again, I'm just looking at that arrow you have that said Fed hikes begin. Wow, the chart is just it's just saying so much in terms of what it's anticipating is going to happen next. So this for me is just an insightful chart because I didn't realize that we had fully recovered from the Silicon Valley bank crash, which was really massive and impacted even startups all over. So that's a big deal that you're not going to see anywhere else, as far as I'm concerned, in major headlines. I was unaware of that until you just brought this chart up.
I'm going to show you something else because let's see, household debt. There's a thing on the Fed, which I think is important on St. Louis Fed. You can basically see that household debt, GDP has basically stabilized here. And, there's a whole new generation of people who can now become, homeowners, borrowers, and things like that. And if this starts to work higher, when you really look at it, people say we have a debt problem in this country and stuff. But the fact is that there's actually space for American households to borrow. So I think it's just important to realize that this is now an industry that has that they're at a spot where their capital levels are conservative, and there is potential for more activity by their customers. So they're kind of at a spot where everything there's demand in front of them, but there's also in their own business the ability to increase activity. It's kind of like you have you're a restaurant and you just open up the doors and the lunch crowd's going to come in like 20 minutes. You've got all your food ready to go and you're ready to make money. And in many ways, that's where the banks are right now. And I've heard people say things like, "Oh, banks are terrible; they'll never be good again." These people who are obsessed with growth investing, obsessed with AI, they're like, "There's nothing good in regional banks; they're terrible." But it's like, then what happens when people start borrowing and lending? These guys suddenly they're trading at low multiples, and suddenly that's where the profit growth suddenly happens, and that's where a mega cap that has already like gone up 500%. At that point in time, it's like, where is your performance for the next 3 to 6 months going to be? So I think that's actually, where we are at the banks here. And I think one of the things also that's interesting to me is when I hear people say things like banks are like terrible, they'll never get better again. You hear these things that in many ways is, a classic sign of sentiment having gone too far in any one direction. And I think you can say the same thing to the upside, but same thing to the downside. When people just think that something is terrible and you're crazy to even think about owning it, that often is a sign that it's not to say you simply buy something because it's hated, but it can be a sign that you're at that point when it is not widely owned. And if you can combine that with the potential for a fundamental improvement, then that actually is very often, what a turn can look like. And I believe that we did have that in these banks.
That concept of a a specific stock or asset or anything of the sort turning because of the negative sentiment, I feel like has sort of been a reoccurring theme on our show, especially from the standpoint of sort of when something is so hated and there's just no buyers there to, to really, there's just no buyers there at all. Sometimes that kind of is the opportunity to a degree. Of course, you want to make something sound and is a good, well-run company. But oftentimes, if it's not too crowded, then there is more room for some sort of reversal of sorts. So this whole aspect of the banks making this turnaround has my attention. And how about the aspect of the banks in terms of the Fed cutting rates again, which I notice is now on the table. There's been some sort of sentiment shift there. Do you think they're still in play if the Fed does cut rates again? Or if they start a cutting cycle?
That's one of the reasons why they're running now, is precisely because of what's going to happen is, as rates start to come down, there's many things that benefit them. Their interest rate margins, their lending margins improve. But also a lot of them have lost deposits because, people were going and buying treasuries. Like people who have large amounts of savings were just buying treasuries directly, something people had not done in decades. But as interest rates and as those yields on treasuries start to move down, there's a certain point in time when it's no longer worth the inconvenience to buy treasuries directly. So they're going to start to get more deposits back as well. But the real thing will be loan volume. Simply the fact of as rates start to move lower, regardless of whether they're still high or not, as the volume just starts to increase, they make money on that. And I think that's really the narrative. And then there's that virtuous cycle with any kind of credit cycle where, once people actually start to see, all right, the housing market is now at a stabilized point or something like that, you're going to start to get more lending in different ways, more building. All these things feed into the banks. And then the other thing is that when people start to do mortgages, there's going to start to be people refinancing. They're going to do cash out refinancing. And all these things are things that set up the potential for more activity. And like we said from this chart, there is space for this leverage to increase. And all that means net growth of business for the banks.
You saying the aspect of refinancing, that's such a underrated aspect for the businesses to then generate new revenue if rates do indeed come down. Now, how about now XLF? This is another. Yeah. The XLF ETF encompasses a little more than banks, right? But still well worth watching.
It is, and I think this actually tells you quite a lot. If you look at basically where XLF was, I mean, the various ways you can see that this was also in a very tight sort of range going into some of these. Let me get this trend line back up. But essentially, you can draw these lines different ways. But the key thing is that XLF here was squeezing toward a breakout. Interestingly, kind of right before earnings season, as the big banks are getting ready to report, rallied to an all-time high, and now it's kind of lurking above those old highs. It doesn't look that different than the Russell. I mean, it is different because it's an all-time high and stuff. But the fact is that this also kind of saw a surge of money in. This includes things like Morgan Stanley, which we did a TradingView idea on today. Goldman Sachs includes the insurers. And so I think, again, this is now the property and casualty insurers. This is another one of those areas. And I think if we are in a spot when people start to say, I need to take money out of growth stocks, and maybe I don't want to buy smaller, more risky stuff, then also things like XLF. And I kind of have been thinking for a while here that I believe if you simply look at the underlying potential where the economy is, the financials and the healthcare both have potential for growth. And the reason is, like I said, this coming down of the potential of leverage increase in the economy is going to be positive for financials, a potential IPO cycle and things like that. All that helps the financials. But then on the other hand, I got to look at the XLV because, this is actually now, look at this is green on the day. Again, a very similar sort of price action where it rallied to new highs at the end of or in the first part of July. We have these higher lows. And what's also interesting to me about this is that the healthcare industry is growing because of the fact that we have, aging population and a growing population. So look at United Healthcare, which is one of the biggest ones in there. It basically had several quarters of bad results or trouble because they had rising expenses. But now they kind of came back with a strong quarterly report. Then some of these other names like HCA that runs hospitals, these are showing business is strong. ISRG, which does the Da Vinci surgical devices. So right now, I'm looking at healthcare as another area where, these are large companies. These are not random speculative companies. These are places where people can be looking to put capital to work. And what's interesting is it's breaking out to new all-time highs. It's green on a day when the S&P is having one of its worst days in a while. And on top of that, it has a bullish outside candle right here. So to me, there's a lot of things that are interesting about this chart. Again, look at how it went up. Look at the close on this candle right here, the first week of July after the holiday. That was the highest weekly close. What did we get? Quick consolidation, follow through. So this pattern on the weekly chart continues to show us stuff. We had talked about a while back when the materials sector basically did this right here. We talked about the highest weekly close on this candle back here in early February, and then we just got a decent follow through. It's kind of interesting to see now how it's consolidating and holding above those lines. This is materials, and I'm not super sure what to think about materials here. You can see that it's kind of drifting in a range here, but this pattern right here back in February is what mattered on it. And we saw a similar thing on XLV, and now we're getting the follow through. So I think financials and healthcare, these are major industries that have fundamental arguments. They are non-tech, non-growth, and we're getting confirmation on the charts. So I think that's just something to think about, because now we're in a new half. We're in kind of a new chapter for the market. And when you see, the S&P and the NASDAQ near its lows of the day and the healthcare ETF near its highs of the day, well, maybe some money is moving from the NASDAQ and from growth into healthcare.
There's two things I have to say about this, which is, number one, I find that a good theme now of this episode, starting with just how we started it, looking at the NASDAQ 100 relative to the Russell, is looking for these little, relative moments of outperformance versus underperformance. And so meanwhile, the S&P 500 and NASDAQ 100 are down today, but exactly as you're showing us, if you look closely or look deeply enough in markets, you can potentially find some assets that are sort of bucking the trend. And what's even more interesting to me are these assets that are maybe not, so, well known or followed. They're not exciting tech companies with headlines every day. It's a company that runs hospitals is currently green. So very, very interesting, I think, and a good lesson for anyone watching who's interested in markets, which is, if the market's going down, it doesn't always have to be a bad thing, because if you look hard enough, you may find that some symbols or sectors are bucking the trend and actually up in this example. So, I hear you're showing us all the relative outperformance, I should say, is what we're looking at now.
Yeah. We're just seeing that utilities are also having a strong day. Now, it's interesting about utilities is there are some interesting patterns in the utilities chart. Now, this is something that probably most people don't want to trade. Not very interesting, but it had this big surge back here in April. And it's interesting is that we are, I haven't actually charted this one recently, but you can see that we broke that. And it'd be interesting to know, I think if we actually look, this is the Friday right here. Let's just kind of see if we try to do the Fibonacci on that. To me, I'm not sure we have the cleanest Fibonacci retracement on this, but we did basically come down and hold, some levels. This is something where there's so many levels to look at, but the key thing is that we did get something of a turn. And now if you look at it, we are also outperforming at a time when the market is down, and that tells you something. And the other thing our utilities is that they benefit from lower interest rates. So a lot of these things are kind of, lining up here. I think the problem with some of the utilities is you can trade them and then they make money for like a few days and then they just go nowhere. And they're not necessarily an actively traded sector, but I think it tells you though that there is something of a rotation underway. And to me, the thing that really did grab my attention though was the healthcare and the financials. Those to me seem to be in an area that has that potential for people to fall back in love with them and get excited about them again, because they really haven't been the famous, big, kind of sexy thing for a long time. And I think that actually is exactly this sort of thing that can sometimes work when we're in a period of rotation, is that the stuff that has really maybe not been hated, but just been forgotten about. But then when you think about it, with the aging population, and if you also look at some of the things, United Healthcare, they had a lot of problems that now seem to be on the other side of and getting past. And you had good earnings in some of these other names. So to me, I think healthcare is at a spot where it makes sense at this moment in the cycle. And I've been kind of watching and waiting it.
So to add to all of this, I have to say, what I really find interesting, once again, is the live nature of today's show, which was just as you were showing us healthcare, looked up Google, Tesla, Microsoft. Tesla's down 10% right now from yesterday's earnings. And I saw that Microsoft and Google are both down 4%. And if you combine that sheer market cap, right, we're probably talking, some $100+ billion in market cap being erased collectively just from those three companies. And it's just very interesting that maybe these more boring, and you're right, actually, I should correct a statement I said earlier, which is that it's not so much about maybe the companies that aren't liked, it's just sort of boring and hidden companies are, finally going the opposite direction of these companies that everyone has followed now for quite some time. So it's very interesting. And so now you got the NASDAQ 100 up for us here.
Yeah, and you can see this was the price gap from that bullish CPI report back in June 12th, when the market ripped to new highs. There was a price gap, and now we're basically just taking it out. And from my perspective here, this is something where there's a lot of patterns here that were essentially nothing had shown any kind of bottom here on the NASDAQ. And my sense was that even if those earnings had been good, say the earnings last night had been good from Tesla and Alphabet, maybe it would have just sat and drifted and then had the downside risk. But there was nothing here that gave me any clear sense of this thing having, bottomed or stabilized. So from my perspective now, it's one of these things where people might want to just realize, again, it's not about levels necessarily. It's also about time. And I think now letting that time play out, getting through July, letting the selling work its way out. I made a note to myself last month, and I said, my concern is that if we get a rotation, that earnings season could actually be a big selling opportunity, because people often use earnings as liquidity events. So what we could simply see is we could just see a lot of the big tech stocks getting sold regardless of what their earnings are, because people are like, you know what? I've made a ton of money in NVIDIA and Microsoft. Even if it's done really well, I need to own more banks. I need to own more of this or that. I'm going to just, when I have the opportunity, there's going to be selling. And that seems to be playing out, because the selling in something like Alphabet as well. It's like, it's not like it was that the quarter wasn't that bad. And I think also, though, I would just mention that Google and Meta did have both of these had some analyst reports. Well, no, Meta had analyst reports saying that there was weakness in ad spending. And then we see the same thing with YouTube for Alphabet. I would just say here that we could be an interesting spot. If you look at things like the GDP now and some of the more fast moving measures of economic activity, they actually have slowed significantly in the last 6 to 8 weeks. So the thing now is, not a surprise we see it hitting ad spending. But what happens if the Fed does, cut as expected, or things kind of come under control, and we start to see a cyclical improvement in the economy into year end? Well, we could actually see something like Meta and Alphabet. Those companies might actually benefit going into Christmas. So we're going to put out some ideas here that going into the last part of the year, once we get kind of through this period, get through the third quarter into October, November period, then these stocks could be in a spot where they might have gotten cheaper. But I think we have to realize they can be getting cheaper for a while, which isn't much in, that's not a bullish thing. So the thing I think to realize is that you can map out how this rotation can work out, which is rotation to the cyclicals and the value names for the next few weeks, the next, month or two, then some kind of wait and see what happens, but then a potential, return to the growth names later. So I think it's important to kind of play out different scenarios, and you realize that they might not all play out, but you can start to see how any of them make sense at any given moment in time.
So this chart of Meta is also interesting because I feel like they've done a nice job of pitching their AI push. So I was unaware that they're also dropping on this ad spend, and I should say that you've brought up a few key things that are happening all for the next 5+ months until we at the end of the year, which is we've got the end of the year coming up. We've got an election cycle going on. We've also got this aspect of ad spend, and we have let's take the ad spend out of there. Let's talk about the election cycle, the second half of the year, and a potential for a Fed rate cut. Like, you don't get three events like that very often, all happening at once. I don't know how to digest it fully or unpack it, but it's definitely something I think that we all should have on our radars for how we're going to approach markets through the end of the year.
Yeah, and I think that you know, from my view, the election is, I think that um, there's a great tendency in America of things actually to kind of move to the middle and to simply become, mainstreamed and things. And you feel like it's going to be so dramatic, and then you get there and it's just not. And I think when you see a market like this, there's going to be like fear. And then what happens is, as it comes to the event, things just become not fear. And we think because the last election was crazy, this one's going to be crazy. And what happens if it's not? What happens if everything just goes back to normal? And I think that's really something that the market is good at understanding. Is as that happens, the pieces start to come together. The market rallied before the inflation, and my expectation is that things like the election will turn into big nothing burgers by the time it comes. I did want to just very quickly mention, though, with Nvidia and Broadcom, because if you look at these, we did a chart on this, and you see how this pattern has played out, how it made the lower high, and then what's interesting here is it has that kind of knife to the downside. I kind of have a technique that I look for when something's in a period of neutrality, and I now consider this a period of neutrality because it's under the 21-day exponential moving average, and it's like, you can say short-term bearish, long-term bullish, but it's kind of neutral. Is it basically you get a drift and then you get a dive, you get a counter trend move, or like a one sell off, and then money jumps in and then it starts moving again. And so I think now we could be in a spot to look for something like Nvidia to take a dive down, toward like 105, 107 area in the next few weeks, and then it could get defended on a sell off like that. So I wanted to mention that. And the other one is Broadcom, which is trading very similarly now, but you have this lower high here. And I think also there's a spot where, it could be some drifting, and then people might be waiting for a day when it seems like it's all over and it's getting crushed. And then you realize it's still kind of up on the year. But my point is, this could be something also sideways movement with then some kind of just liquidation that gets bought, and then the bulls come back.
In terms of Broadcom and Nvidia, it just feels like, because of the sentiment lately, I never thought that I would see them actually have a pattern like this, where it actually seems somewhat like things are slowing down and rolling over. It's been such a remarkable run for all these semiconductor and AI empowering stocks that it's just so interesting to actually see that perhaps something is turning over in this area. I'm not making any predictions, just it has my attention.
Well, the one thing I'll say that does seem, this election is that, things about China and stuff, probably both sides of the aisle are gonna, and I just think right now we do have the risk of different things involving China and semiconductors and things that are just kind of lingering out there. I wanted to end because, in the previous webinars, we've started by looking at the 10-year. And I want to just kind of mention that we do have the GDP report tomorrow, and then we have the Fed at the end of the week, and then it'll be another CPI in August. It'll be a big deal. But I think it's important just to realize here where we do stand on this. And I think that at this point, we basically see this, and we've talked a lot about the level, the 432 level, which goes back to June of 2024. On this long, if you look at this on the long term, you can see it goes back here to June of 2024. And if you look at it more, more recently, it's been a high and a low many times. Wait a second. And, it was just, you can see different spots where we've had pivoted along that level, but now we're just kind of sitting under it. And it's possible here that you start to see when trends start, they start one way and then they accelerate. And what's interesting here is seems to be making potentially, steeper sort of moves to the downside. And I want to just kind of point this out because one of these events coming up in the next month could put a hammer to the Treasury yields, and it could actually, get us back below or back closer to 4%. So I want to just mention that because I think that we still need to go back to this chart, which is, I believe, still the single most important chart. It's not giving us much right now, but it's in a condition where it can sit here for a few weeks, but then it could, if we actually get confirmation of the Fed what it's going to be doing, there could be a time when this thing starts to move to the downside, and that's actually something which could turn around and be a kicker for markets to the upside.
Which also is just so surprising from the aspect, or interesting from the aspect, of an article you had sent me and we both had discussed previously. And that was the element of the housing market getting a little bit weaker. Not tons, nothing to, shock markets by any means, but it's just slowing down a smidge, which didn't seem possible 3-4 months ago. So to have that correspond with this 10-year Treasury note, very interesting, speaking strictly from the, the very big macro level. And I feel like that's a very nice way for us to actually sort of wrap the show up, because you're right. We've always started with the 10-year Treasury note and the importance of watching that. And how about, just to take us home to the finish line, as well as you had mentioned, GDP is coming up as well later in the week. Any other big events we should have on our calendar?
Well, the Fed is on the 31st, and it's not clear. Oops, hope you're still there. My screen just went black for a second.
Oh, all good.
And anyway, so we have basically the Fed is on the 31st. We have payrolls, on August 2nd. I think CPI on August 14th is the logical one to be focused on. That's probably just where I think we're going to want to be most aware. But I don't want to really pin on one thing. It's just one of these things where it's not always a catalyst you think. It could be like there could be a really weak initial jobless claims, and that'll do it. It's not super clear. What's important to realize is it's like that the dead tree in your backyard that one day it's not clear what's going to make it fall, but it's dead and it's going to fall down at some time. And I think that's kind of where we are now for treasuries. Is the market sitting and watching, and we have that potential for one of these events to really be the catalyst. Tomorrow's GDP report will include some price data, which is important, but then also there's another number that comes out later. The unit labor costs will come out later. So there's a bunch of these little numbers, and if you actually look back to November of last year, it was a unit labor cost that really triggered the rally. It's a number no one ever pays attention to. So I think right now we're in a spot where there's a bunch of stuff in front of us, and the chart has a certain kind of setup, and we just need to realize that it's there. And that it could be like small caps. Who knew it was going to be CPI that launched that rally? So we could be the same sort of way right here with that 10-year.
David, before we head out of here, what was that number that you just mentioned? I want to write that down for our viewers and get it in the chat. The unit
labor costs on Thursday, August 1st for the second quarter. It comes out after GDP. And if you go back to November, that number for the third quarter was the thing that actually really gave conviction that the interest rates were going to go lower.
What a great little anecdote to end it on, and an indicator which I don't think many people are totally familiar with. So with that being said, let's wrap this show up. And David, I want to say thank you again for being on the TradingView show. If you're on TradingView, be sure to follow the TradeStation account on TradingView. David runs that account, produces the ideas, the great charts. I just don't think you can find many opportunities like that in markets where you can interact with someone so easily through a social network, write comments, give them boosts, all of that good stuff. And also, we do this show monthly, so be sure to subscribe, set your notifications, and you can follow along and enter the chat like some of you already have. So thanks a lot for tuning in. And David, I'll let you go, and we will see you next month.
Thank you, Steph. Have a great day.
See ya.